And here's the strategy. Lender credit, and we'll wait for this next pricing to come up, but if the lender credit is, like we saw in that initial, it's running from a discount fee up to 2+% in lender credit. If you were to select a rate that was paying 1.25, 1.5, you would be able to go borrower paid and charge 1.5, and I could use that lender credit to offset your compensation. So now we picked up a couple more options here. Nothing great. I ran a Titan Prime Jumbo refi. I don't know what the differentiating factor was yesterday, and the pricing was exceptional at 90. It was actually 89% rate and term refi. But for example, here, Elizabeth, you're at 7.875 with a point back. Todd, if you could go kind of back to that original scenario, I hate to keep bouncing you back and forth, but if you could, I want to give a kind of a hands-on illustration of what we got, and then we'll have you rerun it as an ARM. But it allows you to use that lender credit to offset your origination fee. So what we see in a lot of cases is the loan officer is going to try to match their origination to whatever the lender credit is, and they sell it to the client on the premise that they're doing effectively a no-point loan, no-cost loan to the loan officer, because all of their compensation is being offset and paid by the lender. So it really, our aggressive approach in our interpretation of TRID and Dodd-Frank, allowing you to use lender credit to pay your origination fee, really does give you the flexibility to almost modify your lender paid comp plan, because it looks very similar on paper to going lender paid, but it gives you the flexibility to drop your compensation to whatever you need it to be to match that lender credit and deliver a no cost loan, no point loan to the borrower. Did that make sense, Liz? Yes.
Can you please explain what do you mean by lender credit?
Absolutely. As soon as this pricing populates, I'll show you exactly what we mean by lender credit and what we're talking about. And thank you for asking the question.
I was looking at that Titan Prime 90% opportunity that you had talked about. We do have this up to 2 million. I'm wondering what asterisk it was.
It might have been DTI. I don't know what DTI you plugged in. The DTI might have been what excluded.
Oh, you're right. It's 38%. There, that's actually, and I ran it at 40. There we go.
So we'll pull this pricing up. We'll put this issue to bed, and then we can look at some ARM pricing. So, no, could you drop that down to an 80% so we can get some measurable?
Oh, okay. Sure, you bet.
Lender credit up there and walk through how we could structure this.
I apologize.
No, we're good. I'm throwing you all kinds of curveballs. We're keeping it all over the board. Any other questions on the jumbo while this populates? Okay.
I noticed something from that pricing snap that we already ran, that for the very first time, I mean, just to kind of add things that kind of wow me, we're always changing. You may have noticed, and it should come up this with our new snap here, that the Titan AUS is actually equal to the Titan Prime in pricing on this particular scenario.
You know what? That did catch my eye. The Titan Prime Jumbo
never seen it before.
Normally about 1/8 of a point bips. In fee.
10 bips, always.
Better than our Titan AUS. And what's interesting about the Titan AUS, it is an AUS-driven jumbo product that gives us more flexibility with reserve requirements and income documentation. Like, it's not atypical that we would see it asking for a W-2 and one pay stub.
Mm-hmm.
Great let's opportunity. Open up.
Yeah. So here's my pricing: 80% on the $2 million purchase, $760. You're wanting to look at pricing opportunities here?
Yes. So where's the Titan Prime Jumbo on this?
Down here.
Huh. Okay. Normally they put that one right on top. What the heck's our system doing?
So
to give you an idea what we're talking about, we'll look at this rate stack
You
here.
are correct. It's not putting it in order correctly. I assumed that it
Yes.
was correct and something was
Let's just
going
go to the
on.
Titan Prime Jumbo.
Yeah, here we
We'll
go.
just hold right there. So
Yep.
what you can see here, 6 1/4 is paying a lender credit of 1.265. So couple components here. What is lender credit? Lender credit is the additional credit that we're going to provide as the lender to your borrower to be applied toward closing costs for the rate you've selected. So obviously, as we get to lower interest rates, the lender credit goes down. It could actually turn from a lender credit into a cost or a discount fee where they're paying points to buy that rate down. But in this case, and in this example, 6 1/4 is paying 1.265, which the dollar amount of that is $20,240. So if you were to say, you know what, I'm at a 2.5% comp plan, there's no way in the world I'm going to be able to sell this customer a rate that's going to pay me 2.5. I'm going to go borrower paid. I'm going to give them a rate at 6 1/4. I'm going to charge them a point or a 1.25. You would then be able to use this lender credit, this 1.265, to offset your compensation. So that way, what you're delivering to the client, you're charging them 1 1/4. The lender is giving them 1 1/4. That 1 1/4 is being used to pay your compensation. So the net to the client is they're not paying your origination fee directly. I mean, they're really paying it indirectly because you're giving a higher interest rate, but that is how that would work. And that is the lender credit that is available at the interest rate that you would select. And Jonathan, does this apply to all programs? Absolutely. So FHA streamlines, in particular streamlines, because if you go borrower paid, everybody else's interpretation of TRID and Dodd-Frank means your borrower is going to have to come in and write a check for your compensation. With us, if you go borrower paid, you select a rate that's paying lender credit. We will use that lender credit to offset your fee. And if there's any additional lender credit, it would be applied toward title and escrow charges. And if you go VA, we are actually one of the, if not the only lender in the country that will allow you to charge more than 1% on a VA borrower paid transaction. So as long as I have enough lender credit to pay your origination fee, for example, you select a rate that's paying 1.62 on a VA borrower paid or VA IRRRL, which gives you an added level of flexibility and makes you far more competitive than anybody else in the marketplace. I also allow you to use seller credit to pay your origination fee, charging more than 1% on a VA borrower paid transaction. So we give you flexibility that no one else offers when it comes to your compensation. All right. We're going to put Jumbo to bed unless anybody has any other questions. Todd, if you could pull up that ARM pricing so we can go over that with Andre. Just let me know when you've got it and we'll jump back. But we're going to talk about non-QM. And when we say non-QM, we really mean like alternative documentation, alternative income doc. So typical reserve requirement over 1 million, 24 months? No, heck no. We've got programs that will be as low as 6 months for loan amounts over 1 million.
And the
Todd,
AUS loans. And the AUS loans.
Yeah, AUS is going to be determined by AUS. Todd, would you pull up just our most conservative, right? Titan Prime Jumbo, best priced, but also most restrictive from a guideline perspective.
And you want to see the reserves?
Yes, sir. And while he pulls that up, we're gonna shift into the non-QM. Non-QM is really going to be more of our alternative income documentation. I'll give you the different categories for the alternative income, and then we'll do a little bit deeper dive into each one of them and what some of the general guidelines are. But Andre, loan amount $1 million to $1.5 million, 9 months reserves. And again, this is our most restrictive product.
Mm-hmm.
If you said, hey, I've got $1.6 million purchase or $1.6 million loan amount, and I've only got 6 or 8 months reserves, we would look to put you on one of the AUS driven products that would have a reduced reserve requirement. And I've got one of my AUS driven products that prices exactly the same. So when I say we have exceptional jumbo product, we absolutely do. We do a massive volume of jumbo business. I will tell you, we are the absolute industry leader in pricing for this product in the marketplace. So alt doc. We've got a bank statement program, 12 months bank statements. And I even have programs that will go up to millions of dollars with as low as 3 months reserves. So you bring us your scenario, Andre, we will find the product that will match the reserve opportunity that you have, whatever that looks like. Non-QM, I've got a 12-month bank statement program. We love the bank statement program. I've got a P&L only program. And I will tell you, if we love the bank statement program, we really love the P&L product. The P&L product is a true P&L only program. It does not require bank statements. Most of my competition offers some version of a P&L, and that P&L product has to be accompanied with 2 or 3 months bank statements that will support gross income, net deposits. It's got to correlate. So the P&L has to correlate to bank statements. What we see regularly is a borrower comes in, they want us to calculate income, which we will absolutely calculate your bank statement income. We calculate bank statement income. The borrower doesn't qualify based on bank statements. We want to flip them to a P&L. If we needed bank statements to correlate with that P&L, we'd have a problem. Our bank statement program is truly, our P&L program is truly P&L only, prepared by a tax preparer, does not need to be an audited P&L, and we use that income from the P&L to qualify. Todd has pulled up, we have a lot of resources for you guys. Todd has pulled up our Titan Flex, which is our alt doc, what we're talking about right now, quick reference guide. And it just gives you some highlights on the program, what some of these options are. We're going to talk about them in a little bit more detail. So P&L is an exceptional product. 1099 only program that is geared for someone who generally receives one 1099 in a very low expense profession. Prime example, loan officers and realtors. You guys get a 1099, hopefully. And if you don't own the company, you're not paying a lease payment, you're not paying utilities, you don't have a staff. So what we do with that 1099, we validate the 1099, and then we give your client 90% of the income reported on the 1099. So to give you, just put it in real numbers. If you've got a client with a 1099 for $200,000, we give them $180,000 as qualifying income. We're going to give them $15,000 a month. All we do is get a copy of the 1099. We get some evidence that they're still receiving that 1099 income. Could be copies of checks, could be a letter from the employer if they're an independent contractor. So fantastic opportunity for us on this program. Something else that we are equally excited about. We have an asset depletion product, and that takes all qualified assets divided by 60 months, 5 years. Not the Fannie Mae product where your client has to be of retirement age. It will give you a percentage of everything. So latest, 1099 for self-employed. Now, the only problem is we don't offer the 1099 product if they're paying themselves the 1099. If they're self-employed, we would look at using a bank statement or a P&L product, but we definitely have a great alternative for your client that is self-employed. But the asset depletion will take all assets. Your client does not need to be of retirement age. We've got a very simple Excel spreadsheet where you plug in the balances based on the type of account, right? Cash, checking, money market, savings accounts are all utilized at 100%. Investment accounts, retirement accounts are all utilized at a smaller percentage. But again, they don't need to be at retirement age. And we then take the net of that amount and we divide that by 60. And that is the additional income that your client will receive. Now, we have done asset depletion programs where they qualify exclusively on asset depletion. But what's far more common and what is an amazing opportunity is we take someone that's receiving Social Security income. They may have some pension income, but they've also got a big chunk of money sitting in a 401k or some form of retirement account. And I can then amortize that and use that in conjunction with the other type of income. So Jonathan, awesome. Don't have to be retirement age. Couldn't do a deal because my client's funds were in savings and checking and not of age. We've got the product for you. Hopefully you can call that client back and we can reel them in and get them back on board because this product is exceptional. And what's nice about all of these alt doc programs, they do allow us to blend income types. And what I mean by that is if you've got, a husband and wife, and the husband is self-employed and we're using P&L to qualify or bank statements to qualify the husband, and the wife is a school teacher with a W-2 and a pay stub, I can get the W-2 and pay stub on the co-borrower and combine that with whatever form of income you have. And we could even then take asset depletion on top of that. So bring us your deal and we will walk you through step by step how we're going to put it together and how we're going to help this client qualify. All of this, something else exciting, okay? If you've got multiple borrowers, we qualify based on the primary wage earner's income. So this is going old school, subprime days, where we are going to qualify based on primary wage earner income, not lowest mid score. So the mid score of your, I'm sorry, I misspoke. We're going to qualify based on the mid score of your primary wage earner. So we give you a lot of flexibility there. Minimum credit score for these products is 660, with the exception of the P&L. The P&L does require a 680. We will go to loan amounts up to 3.5 million on this product. LTV up to 90% at 1.5 million. We'll take refis up to 85% LTV with no mortgage insurance. We allow entity vesting on all occupancy types. So that is something unique. It's a niche for us. We will allow you to vest in an LLC. Most companies, entity vesting is non-owner only. We allow you to vest in an entity owner on owner-occupied properties or second homes. We have unlimited cash out, meaning there is no dollar ceiling on the amount of cash out that your client can get. We allow you to use cash out to meet any reserve requirement. We allow the use of ADU income. Any legally permitted ADU, we can use that as qualifying income. So that, guys, in a nutshell, is our alt-doc non-QM product mix. Let me open it up real quick for any questions that you might have on that product. Okay, looks like we have no questions. We're going to move into the third segment of this, which is our DSCR program. And if you're not familiar with DSCR and how that works, it's very simple. DSCR is debt service coverage ratio. That is the product where we use the rental income from the subject property only in qualifying for the loan. So we have multiple product options. We have coin. I don't know why we couldn't just call it DSCR. We had to come up with a fancy name. Todd's going to pull up some pricing on just kind of a standard DSCR purchase transaction to show you how powerful this pricing is. But the coin is cash flow only investor loan. But we have a couple different options there. We also do a foreign national DSCR, which is again an exceptional product. Because this is considered a business purpose loan for us, we allow you to lend in 34 additional states with no state or NMLS license being required. Todd's going to pull up the pricing. Our pricing is excellent. Now, on this product, there is no employment or income documentation provided outside of the cash flow of the subject property. So that means on your application, you don't list the borrower's employment, you don't list any income. All we're going to do is get a copy. We're going to document the rental income from the subject property. And to give you an example, if the rental income was $1,000 and your monthly payment was $1,000, that debt service, you divide one by the other, the debt service coverage would be 1.0. If the rental income was $1,500, and your mortgage payment, PITI, was 1,000, your debt service coverage would be 1.5. So we have programs that range from 1.0 and up with additional pricing incentives at 1.25 and 1.5, all the way down to a no ratio program. Most people do not offer a no ratio program. What I mean by no ratio is we're not concerned with how bad your debt service coverage is. We've seen scenarios where we had rental income of $500 with a payment at almost $2,000. That would give you a debt service coverage ratio of 0.25. We funded that loan. Most lenders are going to be capped at 0.75 or 0.85 to be able to put that together. And when I give you an example of how powerful our pricing is, when you look at Fannie Mae pricing, a couple of years ago, they made additional adjustments and additional LLPAs where, the adjustment for a 75 or an 80% non-owner occupied is 3% to fee. The pricing is very challenging. In this case, Todd had pulled some pricing up. We'll see what he's looking at.
I'm kind of showing the difference between a 75% fully amortized pricing and payment, and now I'm running it interest only to illustrate the ease of bringing that into play.
Okay. So again, we go 1.0 plus, we'll go down to a no ratio. On this product, we qualify based on the highest mid score. So there is no primary wage earner because we're not calculating income. So what is awesome about this program and unique to Orion Lending on the DSCR is we will allow you to qualify. So if you have, two partners on a transaction, one of them has an 800 score, the other one has a 640 score, we qualify and price this based on an 800 score, not the lowest mid score, which is what most lenders will do. So Jonathan, you've got a DSCR working. Would we use rent schedule, or the rent schedule came in at 3,000, active lease is 2,800. It's a cash out at 75. So what we've got for you there, Jonathan. So Jonathan's question is, how do we qualify this borrower? And the answer is, when we've got a situation like that, the rent schedule came in at so the rent schedule came in at 3,000. The active lease is 2,800. We will use the lesser of the two. Now, if we see that the lease was at 3,000 and the rent schedule came in at 2,800, so when the actual rents being collected are higher than the rent schedule, as long as we can document that, if it's within 120%, meaning in this case, we're well under the 20% threshold. As long as I can get evidence that they've been receiving that higher rental amount, we will use the higher rent. But Jonathan, specific to your case, where the rents are lower than what the market rent is, we would use the lower of the two. Now, I would like to, Jonathan, connect with you on that because I have a suggestion where we could resolve that very quickly and efficiently. But I'll take that offline. We're recording this. I don't want to incriminate myself. But we'll jump on that call later. We go down to a 620 credit score on this program. LTVs up to 85%. Again, lender credit is available. You can use lender credit to pay your compensation. And we're one of the only lenders in the marketplace that will still give you lender credit even if you select a zero prepay. If you're familiar with DSCR, this is going to catch your attention. We will take first-time investors. We will also take first-time home buyers, which is completely unheard of in the DSCR space. Most of our competition, if not all of it, will require your client to own their primary residence in order to utilize the DSCR program. We don't. I will allow you to use the DSCR for a first-time home buyer. Your client can have unlimited financed properties. And just to touch on the pricing real quick. Here's pricing that Todd pulled up, 75% LTV, which is kind of a standard DSCR purchase transaction, 740 credit score, and this is a property that cash flows. And this is with a 2-year prepay. And I will tell you, there's a negative price adjustment for a 2-year prepay. If they take a 3-year prepay, they're going to get better pricing. But even with that said, An interest rate at 6.625 is paying lender credit, paying 0.15. If you get up to 6.875, it's paying 1.275 in lender credit, which could be applied to your compensation or could be applied to the borrower's closing cost. And this is on an interest-only payment. Something nice about the way we calculate our DSCR, which is calculating that ratio, we will actually use the interest-only payment when calculating that 1.0 or 0.89. So it gives us an added advantage if we're really tight on DSCR, or it's a purchase transaction, the property's vacant, and the market rents come in at $2,800 instead of $3,000 like we expected, and your payment is $2,988, we would automatically call out and say like, hey, Carlos, guess what? You know, your DSCR is at 0.99, 0.98. We'd like to flip this to an interest only. By dropping the principal portion of the calculation, it's going to allow us to get your cash flow back up to 1.0 and give you the same pricing and the same LTV that you were expecting. So, Linda, I'm going to read this. Got a borrower looking to purchase an owner-occupied primary residence, 750. Highest FICO score is 664 with a mid score of 659, self-employed, and would be using 12 months bank statements. So they want to put 10% down. I don't have a great product for you in that case. So to summarize what Linda's looking for, it's a bank statement program, mid score 659 with 10% down. So for my bank statement program, I need a minimum 660 mid score. So from a pricing perspective, I'll use the highest score. For a qualification, we've got to have everybody at a 660 or higher. And in order for me to go 90% LTV, I need a 700 credit score, or 720 if you want the higher loan amount. And for this loan amount, we would be fine at 700. But if you're at a 660 credit score, my max LTV is going to put you at 80%. So unfortunately, we don't have the right product for you there. Now, I would say let's maybe try to look at going full doc, bring in a co-signer, find a way to get you what you're looking for. But back on this DSCR product, so first-time investors are okay, first-time home buyers are okay, unlimited number of finance properties is acceptable, large deposits are not sourced. So one, we do allow gift funds on this program, but some people don't want to get a gift, don't want to get a donor, don't want to do something else. We do not source large deposits. They just deposited $35,000 into their account. That's okay. We may ask for an LOE. Where'd this come from? You just tell us where it came from. You don't need to show us where it came from. That's the difference between the sourcing and the seasoning. Tell us the story, but you don't need to back it up. Like I said, gift funds are allowed. Rental income from ADUs are allowed. Interest only is a really powerful tool because we use that interest only payment to qualify. You can use cash out for reserves. And if your LTV is at 70% or below, there's no reserve requirement, period. So you don't need reserves. You can take cash out with less than 6 months seasoning. This is another product where we give you unlimited cash out. We're literally working on a $2.5 million loan right now on a free and clear property. $2.5 million in cash out, and we're willing to do that transaction. We will do up to 4 units on this, and we also offer this product on mixed use. So 2 retail units in front, a house in the back, all of that is acceptable. We take foreign nationals on this program. Foreign nationals with absolutely no credit. So no credit report, no credit score, no foreign credit documentation. A lot of our competition, when we do a foreign national, they want credit letters from the country of origin. They want to establish some form of credit. We don't require that. Our foreign national is absolutely the ease of doing business. So DSCR, first-time home buyer, we either go 70 or 75%. Todd or Dylan, are you guys certain on that? DSCR
75%. 75%, minimum 700 FICO, and cash flowing investment.
Okay, so yep, we will do 75% latest for you on that one. Okay, Carlos, mixed use up to how many units? So we're capped at 4 total. So in your situation, you've got 2 commercial, 4 residential, you've got 6 total units. We wouldn't be eligible for this. If you had 2 and 2, 3 and 1, we can absolutely help you with that. So those are all of the nuts and bolts that we wanted to go over. So at this point, we're just going to open it up for open discussion, question and answer, and we'll see what we can do to help you guys answer any questions you may have. So feel free to unmute yourself and ask any questions, anything you want to touch on.
Hey, Jason, just the quick reference, guys. We can get those from the website, right?
Absolutely.
We get a copy of it.
Yep, everything is available on the website. You go under products and rates, and everything is there. And if you're not familiar, if you don't have credentials, please reach out to us because we've got some powerful information there. The pricing engine is there. It will allow you to go price all of these. It's an intuitive pricing engine. So if you input a scenario that doesn't fit a particular product, it's not going to give you pricing on it. And it will tell you why it's not giving you pricing. In addition, we've got an exceptional marketing studio. We've got 200 plus flyers on every product that exists. I've got flyers available in English and Spanish, completely customizable. They don't say anything about Orion. You can plug in your information, your headshot, your company logo, and please leverage that marketing. The brokers that use it absolutely love it.
No,
Yes,
absolutely.
minimum loan amount on a DSCR is $100,000. Yeah, Dylan answered that. Yes, $100,000 on the DSCR. Quick look at our marketing studio. Excellent flyers. Everything can be co-branded with you and a realtor partner. Literally take advantage of it. We've got open house flyers that are interactive with your local MLS. If you type in an address or the MLS listing number, it will pull the data and the photos from MLS. And like I said, just an excellent resource that's available to you.
For the, to see if I understood, for the, oh, sorry, for the lender credit, so if the client is getting a credit, we can use that to pay our compensation, and then like if we decide not charge any like compensation to the client, right? Is that what how it
Yes.
works?
So effectively, you would be charging compensation, but yes, you've got, let's just say $10,000 in lender credit. You're going to charge $7,500. You would be able to use the lender credit to pay your fee, and the remaining $2,500 would apply toward title, escrow, prepaids, any other closing costs. If there was $10,000 in lender credit and you wanted to charge $10,000, you could still run it that way. You could use that $10,000 to pay your origination in full. Absolutely.
Do we have to select a specific option, like when, let's say, when we're locking the loan or something like that, like to do it that way, or
No.
or no?
We just automatically will do it. You will just select that you're going to go borrower paid. You would disclose your compensation amount. And then when you go to lock the loan, the first thing we're going to look to do is apply that lender credit to cover your compensation.
Got it. Okay, thanks.
Okay, excellent question. And we are really aggressive in this area. Not every lender, and in fact, most lenders will not allow you to use lender credit to pay your compensation. Okay, guys, any other questions that we can help you with?
Just one question. I know that the doctor loan is coming out on February 9th. So I'm assuming by then, the day after, we should be able to have your matrices and guidelines and all of that, right, available?
Yeah, you know what? I have the guidelines. I think I'm the only one, the only AE in the company that has the guidelines, and I've got the final draft. If you want to, Carlos, shoot me an email. I will deny that you ever got them from me, but I will send you the guidelines. And if anybody else wants guidelines on it, thank you. That wasn't me. If anybody else wants the guidelines, shoot it over, and I'll be happy to send you the guidelines on the product. Really, the most important thing that we don't have is pricing, because I've read through the guides. They look fantastic. It's going to be so I look at a program like this as a couple different things. One, it's a viable tool that we can use to go sell and close more transactions. But you reach out to realtors and they're like, Carlos, it's great to hear from you. What do you have that's new? Right? The wrong answer is, well, I mean, I got a new pair of shoes. You know, my kid's got a new dog for Christmas. Nobody wants that answer, but there hasn't been the introduction of a really new product in the marketplace. What we see is, you know, we might modify and go to a lower credit score on this or give some, you know, relief on reserves on a particular product, but there hasn't been something new. This is giving you something new. This is brand new. And everybody talks about the doctor program, but outside of a handful of credit unions, there's really nothing available on the third party to brokers to be able to go offer realtors. So this is one, a really viable product for you to go sell, but it's a great talking point and something fantastic to put on your social media or to advertise, to drive those realtors to call you. And I am happy to share it. The one thing I can tell you, that Titan Prime Jumbo that we offer is our best priced jumbo program. They're the investor that we're going to deliver this doctor program to. So it's very encouraging to me that we're partnering on this with the guy that gives us the best pricing we have. So I think it's going to be priced aggressively, and I think it's going to be priced well. And not every doctor is going to need to go 100% LTV to 2 million with no mortgage insurance, which gives us flexibility. They may have 20% to put down, but they're not going to qualify with the $400,000 in student loan debt that they have. And we omit that student loan debt right out of the gate. And Jonathan, thank you very much for the kind words. You're a valuable partner for us. I appreciate your business, and I really appreciate you, you know, saying something nice. Andre, can you start lender paid and flip to borrower paid during the transaction? Absolutely. So if you start out lender paid, it's a simple change of circumstance to flip from lender paid to borrower paid. So say things go haywire, we need to give your borrower a significantly better interest rate. You want to drop the rate. It's still paying 1.25%, 1.5%. You could then flip it from lender paid at 2.5 to borrower paid, drop your comp to match the lender credit, and you could absolutely set it up that way. So we're getting some really good questions on compensation, how to really maximize. I mean, we want a partnership with you guys. And I hope if there's one thing you see, number one, we have great product. We have great pricing. But more importantly, we've got the expertise and the manpower to really partner with you and help you figure out how to put your transactions together and get them closed. And when you end up, like literally, Todd says this all that, bring us your problems, right? Bring us your problems and we will help you have a solution to those problems. And we will execute and deliver on that. So guys, this is your window of opportunity. Elizabeth, I know you generally have excellent questions. I don't mean to put you on the spot, but anything we can answer for you?
Not right now. I'm just thinking about what you said.
Okay.
That's about it.
Andre, thank you, Elizabeth. Andre, thank you for joining us. We are going to do another training. You'll be getting information on it. The next upcoming training is going to be on down payment assistance. And I will tell you, jumbo pricing is excellent. Our underwriting is fantastic. What we will do to partner with you is good, but our DPA is the absolute best door opener in the industry. I've got 3 different DPA products. Credit scores down to a 600. Your client does not need to be a first-time home buyer. There are no income limits. I offer DPA, FHA, USDA, and conventional. I've got DPA product that is literally forgiven at the close of escrow with no recorded lien. So you're able to streamline that client after they make 6 payments. I can still do down payment assistance, 100% financing for permanent and non-permanent resident aliens. Non-permanent resident aliens can't go FHA any longer, but I can put them on a conventional program and we could go 100% financing for your non-permanent residents. Jonathan, I look forward to connecting with you later. Thank you very much for the participation and joining. And yes, the doctor loan at 100% LTV up to $2 million has no mortgage insurance.
I do have a question, Jason, with the DPAs. With that one borrower we've been going back and forth on.
Yes.
They hit me with something else, so I wanted to talk to you about that later, probably not on the call.
Hey, if you listen, everyone can benefit, and if they don't want to listen, thank you for joining us, and they can hang up. But listen, if it's a real life scenario, DPA, feel free to ask the question.
Okay. So we talked about they had the 13K in can't think of the stupid word. What's the word? Collections.
Yes.
And so they're working on doing like upping their credit. We did all the authorized users and all that jazz. Now they're going into a credit program. And if they do that, is it possible to still go USDA even if they're in the program with that 560 credit score?
560 credit score? No, they would not be eligible for USDA right now. We need a higher credit score for USDA.
Yeah.
And if they're going into some type of a credit counseling program, it's going to put that. So here's the rub on credit counseling. And
Yeah.
they call it all kinds of different things these days. But with credit counseling, number one, in some cases, the credit counseling agency will try to negotiate reduced payments with the creditors. And in some cases they accept it, and in some cases they don't. But in a lot of the time, even if they accept, okay, your minimum payment's $100, you're going to pay $50, and we're going to help you get on track. Even though they've agreed to that, if the borrower makes the $50 payment, the creditor is going to start reporting them as delinquent because they're not meeting the minimum payment. So sometimes this credit counseling that's supposed to, like, long term will help them get out of debt, but in the short run, it's going to ruin their credit. Your 560 could turn into a 520 instead of a 600, like we're trying to get to.
Yeah. So, because she asked me about it, if she should do 1 month and see what happens. And then I was like, I don't think so if you're trying to move by March. But I wanted to get your take on that one.
I don't, 1 month isn't going to help her. It could only hurt her, in my opinion. So if the goal is for her to get moved in by March, we need to have a better plan that does not involve credit counseling.
Okay.
Okay. Thank you for the question. Raj, would you be able to flip from borrower paid to lender paid and increase your compensation? Good question. I love you, brother, and I'm not surprised you asked that question, but the answer is no. So one thing we cannot do is increase a fee to a borrower once we've disclosed the LE. So the caveat to going lender paid to borrower paid is we're like, even if we only drop the compensation by $1, I can go lender paid to borrower paid. But if we want to increase comp, let's say there's a great run in the market and we want to, you were going borrower paid at 1%, and now you have the opportunity to lock at a rate that would cover your compensation going lender paid. We'll allow you to do it, but we're going to have to re-upload and redisclose that file. Most lenders won't even allow you to do that. We will let you do it. You could literally upload you have an approved loan, upload a new loan, a duplicate of the exact file, disclosing it going lender paid, lock it today going lender paid, and we'll be good to go.
Hi, I want to mention something because I had a friend who joined one of those programs that Elizabeth was talking about, and the way that
Yes.
they work is that um some banks they're already like in a type of program where what they do is they lower the interest rate, so that consolidation company or whatever, they already know the banks that are that like adding like that are allowed to, like, they want to do be in that program, so they offer a lower interest rate to the clients, and that's how they can make lower payments. And she said she was a friend of hers, she was able to buy a house even in that program. So I guess, does that depend the type of program? Because I don't want to, like, if a client says that they want to do that, I don't
Yeah,
want to recommend they
it's the
do it if
same
they can.
program. And it just depends on how, like, some of them are very good and very reputable, and some of them are a little bit more difficult to work with. And it just, to a great extent, I mean, the question I would ask is what's going to report on my credit? Am I going to get late payments on my credit report by entering this program and entering this agreement? If they're simply dropping the interest rate and the borrower is still making the minimum monthly payment based on that lower interest rate, you should be fine. But in some cases, they just negotiate a reduced payment amount. And I have seen it multiple times where it will then, as a result, end up with lates showing up on your client's credit report, which effectively does. They're more concerned about the credit workout, about the payment, the debt relief, than they are protecting or increasing the borrower's credit score. But again, I'm not a credit report. I'm not a credit company expert. I'm just telling you from personal experience what I've seen.
I appreciate that. So I'm gonna go ahead and text her, like, make sure you mention this, just because if she wants it, I can't tell her not to.
Yeah, of course.
But make sure to ask this, and that might click the light bulb for her to go, oh, maybe
There is a potential downside depending on the actual agency itself. But guys, we are sitting right on 1 hour. We want to be very mindful and respectful of your time. We're happy to hang out and answer any more questions you guys might have. But that wraps up our presentation for the day. We did get it recorded. The recording started a bit late, but everyone that was on the call will get an email with the full recording on it. And I know if anybody would like to have a specialized, like a personal training for their team. I know Jonathan mentioned wanting to share the recording with his team. If anyone would like to set something up specifically for your team or do something in collaboration on, for example, a down payment assistance training with your realtor partners, I am happy to jump on that. I'm in Rancho Cucamonga, California. If you are in Southern California, we will come and do it with you in person. If you want to do a Zoom training, we're happy to do that. Really, what it boils down to is just let us know what we can do to help you grow your business and grow the partnership that we have with you. And thank you guys for joining. We'll stick around for a couple minutes, but otherwise, that's it. The training's over, and we look forward to working with you guys on your next deal.
Thank you.
You're welcome.
Bye.
Bye-bye. All right, guys.
Jonathan asked if he could set something up next month for the DPA in Anaheim.
Oh, 100%. Absolutely. Jonathan, you're the last one left. You want to put it on the calendar right now, or do you want to connect with your team and some realtors? Whatever you want to do, we're in.
Perfect.
Okay, I know he said he had to run. All right, guys.